Well, it has been a busy week for the Federal Reserve, and there wasn't even a policy decision. That's still 2 weeks away, but we've heard from several Fed presidents offering their perspectives on the future path of rate hikes as inflation cooled in June. And on top of that, James Bullard announcing Thursday that he's stepping down as the president of the St. Louis Fed after 15 years. Joining me now is Jeanna Smialek, New York Times Federal Reserve and economy reporter, also author of Limitless, the Federal Reserve takes on a new age of crisis. Jeanna, it's good to see you again. So certainly a busy week here for the Fed in terms of some of the comments that we got out from Fed officials, but also the slew of data and how they are looking at their fight against inflation, maybe how successful they have been. How do you think the Fed is looking at the reports, the CPI and the producer prices report from this week?
Yeah, I think that the Fed has got to be sighing just a huge heaving sigh of relief at this point, because it was a really good inflation report, this last one, and it was good for all of the right reasons. You know, we saw a slowdown really across the board. Services prices are finally slowing down a little bit. We're seeing a slowdown that extends to everything from airfares to used cars to new cars to rent. And the fact that it's got so much breadth, the fact that we're seeing a slowdown in inflation that sort of spans a lot of different price categories is great news from the Fed's perspective, because it means that this might be sustainable. That's a big difference from the last time we saw a slowdown. Like, we've had some false dawns before. We've had times when inflation really looked like it was moving down and then popped right back up. But I think the thing that distincts this moment is that we're seeing a really broad-based slowdown. And so I imagine the Fed is feeling a lot better after this week.
Jeanna, what about the timing of the coming meetings here? So we have a meeting later this week with the Fed decision. Obviously, traders largely expecting the Fed to hike another 25 basis points. But then we have Jackson Hole. So the next decision after that isn't until September. The fact that the Fed is able to buy more time to look at the economic data, is that a huge advantage?
I think this is actually great news for them, because we know they're going to move this meeting. They've made it very clear that that's the intention. Nobody has walked it back, even after the inflation report. So it seems very likely that they're going to raise rates another quarter point, which almost immediately makes the debate, what happens at that September meeting. But we just have such a long time. We have 2 inflation reports. We have several jobs reports. We just have so much data coming in between now and then that we have plenty of time to sort of suss out whether the cooling down that we're seeing right now is legitimate, whether this is the real deal, before they actually have to make another choice. And I think you can see how important that is by the fact that even Chris Waller, who's probably one of the most hawkish members of the Fed's voting committee, made a speech last night where he said, we are going to hike rates. We might hike them twice more, but that second hike, it's going to hinge on whether we see inflation picking back up. If inflation continues to look like it has in the last 2 reports, we might not do that in September. So, I think we've got a very data-dependent Fed for the next couple of months.
Well, Jeanna, we also had the news this week of St. Louis Fed President Jim Bullard stepping down, resigning. And we know that he has been one of the most vocal hawks, at least as of late, to raise rates, saying that it's very important to get ahead of the fight here against inflation. Do you see any significant near-term implications of this move?
Yeah, I think one interesting thing about him leaving is he does tend to be sort of a bellwether for the hawkish side of the Federal Open Market Committee. So he's not a voter currently. He was going to term out fairly soon anyway. Fed officials have to retire from their reserve bank jobs eventually, and he would have within a few years. But I think that what's really meaningful here is we're not going to have that super hawkish voice that he has been bringing to the table. He worked very closely with Chris Waller, who's a board governor at the moment, but who previously worked with Bullard at the St. Louis Fed. And so we may still get some of that flavor in the conversation from Chris Waller. But I think Bullard was always a little bit, louder and more forthright with his views than I think just about any other Fed official. And so him leaving will take that element out of the conversation.
And Jeanna, with him leading, there has been some reports, or I should say maybe more of the focus just about what is exactly going to be discussed at the meeting later this month. And maybe not so much about future rate hikes, but what it's going to take for the Fed to cut down the line. How do you think the Fed is looking at that decision, and how much of that conversation do you think will be focused on that angle?
I would be surprised if very much of the conversation at all was focused on that angle. I don't think that they think that they are at a point where we are even having a conversation about cutting interest rates. Inflation may be at 3%, but 3% is not 2%. And that's the headline number, which incorporates a big decline in gas prices that you wouldn't necessarily expect to be continued. And so I think they're probably looking at that core inflation number. That's still at 4.8%. That's quite a bit above the 2% run rate that they feel comfortable with. And so, we're still not at target. We're headed in the right direction, but I don't think they're going to be so ready to declare victory that they're already having a conversation about when to cut interest rates.
It might be quite some time before we hear that. All right, Jeanna Smialek, always great to have you. Thanks so much of the New York Times.
Thank you.